We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Vs Financial Partners. Good morning, PB. Thanks
Morning,
for
JB.
jumping in. I know you've got a very busy day, lunching this afternoon with a few clients. And Ben, welcome back from
Thanks, Jay.
sabbatical.
First one back in 3 or 4 months.
4 months.
4 months since the last recording. So
How was the trip?
it's good.
Yeah.
It's good. Bit hard to get back to reality, but it's got to be done. Left with low interest rates, came back with high ones.
Left with a... what was the market doing when you left?
Market was bad while I was away, and it's improved significantly since I got back, and I think there's a bit in that.
Yeah, maybe.
What else has changed in the 3 months since you were gone?
I've lost a bit more hair. Not too much.
Is
It
that
just sort of
possible?
slides back in. Yeah, I don't know. It's not much left. It's a bit windy out there, so
I was sure you were going to come back with a beard and no hair and look a little bit
I've got a
more
few
like
grey
that.
spots coming through what there is of the beard.
Kari
It's
always
not
says
much.
that Ben's morphing into Jay. You got the same
I'll have to hit the
rod
gym.
and gun shirt, same
You've
same
got
cargo
same size
shorts,
arms.
pants. Sorry, yeah. Now, PB, Ben had an idea that we're going to talk optimist, pessimist. He's going to throw a couple of scenarios at us, and they probably relate to all the things we've just spoken about that have occurred while you're away, Ben. And there's been a fair bit going on this year for sure.
I think the start of the year, obviously we kicked it off sort of Russia-Ukraine conflict and still lingering, isn't it? So that started it. Then we've had an election, rates are on the rise, cost of living. Everyone's feeling it. Everyone's talking about it. So I thought maybe we'll just talk through a few of those things. And Jay, always a little bit pessimistic with the world, and PB, the eternal optimist. So I thought we could
hang on. I've said this before. I've said Mum's the pessimist, Dad's the optimist, and I'm somewhere in the middle.
A blend of the two.
I'm the realist, but I'll try and be the pessimist today.
All right. I suppose we'll sort of just work our way through them. A lot of it, again, a lot of the conversation you hear, and people are talking about it a lot. Interest rates on the rise, and I suppose, does it keep going up? What sort of indicators are the government looking at? Some people are feeling it really quickly. Others have still got fixed rate loans from a mortgage perspective. So there's probably going to be a bit of a drag on those. So a lot of those were probably, starting to come off the end of it. Sadly, mine ended the other day, and you start to go, right, you go back to the market and you see what the difference is. And we even talk a little bit, Jay and I were just talking before about, don't just accept what the bank gives you at the end of your fixed rate. You've got to now sort of roll your sleeves up and have a bit of a conversation with them and look at your options, because the difference is pretty significant. So I suppose from a interest rates perspective, what do you both feel where we're at now?
Let me start with the pessimistic view.
Always end up with a good one.
Finish on a positive.
First of all, if you're gauging what clients are actually saying, there's certainly a sense of unease amongst clients, particularly those with debt, or those that are impacted by the increase in rates, which is those with property that they may be looking to realise. The pessimistic view is that we're only just seeing now the impact of rate rises. Like you said, the fixed rates for a lot of people, we were able to lock in a fixed rate for a period of time, and that probably doesn't really come to fruition for another 12, maybe 18 months. So we're probably not going to see, I think we're in for a very difficult 12 to 24 months, and I've been saying that consistently with clients, that the impact of rising rates is sort of a multifaceted. The fact that it's going to sting people from a cash flow point of view. If people are looking to realise property, it's probably going to have an impact on their property values. And it also has the potential to really, which is I think the intended purpose, it has the ability to affect people's borrowing capacity, which again throws people into a bit of a spin when they can't do exactly what they thought they wanted to do previously. So, I said to you just before we hit record that Kari, my wife, was saying to me, why the hell how does this help inflation? Like, how does increasing rates actually help with inflation? And even though I know the methodology, it's still really hard to explain to people the fact that, actually we're going to put people under a lot of pressure so that they tighten their purse strings and that they don't spend as much, which should then reduce some of the costs of living. Now, I know that's probably jumped from rates into inflation, but again, the pessimistic view is that people are going to do it tough for the next 12 to 24 months, I think, and it comes back to the importance of getting good advice. Like all of the principles of financial planning and advice, this is like money time. This is game time now, and you can see the benefit of positively planning for cash flow, making sure that your borrowing capacity is done within the realms of what you can afford, and from an investment point of view, which I know I'm jumping into that as well, this is the time that you can benefit from opportunities, not just be blindsided by the markets and their volatility. Anyway.
You don't have to fear the increases if you've provisioned well, and we knew rates were going to go up, so it's unless you had your head buried in the sand, you would have known this was coming. So we've provisioned for that, we've made sure it's available, and then you can, off the back of that, also take opportunities. So,
well, I think the problem is that the majority of people do have their head up, head in the sand. They do, and that there is still only a very small portion of the population that are actively sort of seeking advice, talking to people, getting counsel about how they balance out all these things. And those people that have managed it well up until now, I think will sort of cruise through and actually benefit from what's going on. Those people that haven't and maybe have had their head in the sand or up their arse will struggle, and that's unfortunate, but that's a reality. So
you're getting a little bit too positive there. So
I know. All right,
I'd like Peter to go on the flip side.
I think the optimistic view of the negativity, and there's no question the pessimism, it's valid because at the moment it's a tough time and it won't get better in a hurry. But the whole philosophy of crisis creating opportunity, and I think if you think about what's going on now, maybe it puts a lot of stuff in perspective. People look at what they're doing, what they have done, what they were planning to do, and it becomes a bit more realistic, is what I'm trying to say, because we have to have periods of bad to actually appreciate, I've got to make good decisions so that long term good things will come from it. And if we don't have those moments, like you can't have the rainbow without the rain. Like, so we have to see the shitty times and see that, this is putting a lot of pressure on my cash flow. And if we have interest rates rising a bit more quickly now, it's this moment we're dealing with. It's not the next decade, it's not the next 20 years. If we use that as a bit of an awareness and a bit of an awakening and learning, so, well, okay, let's manage things better. And I think your point, Jay, if people come and get some advice and actually don't just run with the optimistic view, rates are low, I can borrow lots and house prices keep going up. Well, that's not how it works. Like, it doesn't work that way. That's not the real world. And having been doing this now for 26 and a half years, nearly 27 years, it's just another one of the cycles. And the negative cycles keep coming along. They're there to teach us the damn lesson.
Do you have a sense that the cycle, one of the things that's caught people out is the fact that the positive cycle of low interest rates and markets being really quite favourable, like it extended out to kind of 12, 13 years.
It lasted too long.
Yeah.
And so it was always going to, we talked about the market correction stuff, like the market had done so well last year. In spite of the Ukraine-Russia crisis, we were going to have a correction of consequence. We just had an exaggerated correction because of some other variable that came along. We haven't. We can't continue to have interest rates down at 1.5% or 2%. That's not realistic, and that's not historically what the average interest rates are. So give or take where we are at the moment, in that 4 to 5% range, is around about where historically interest rates have been. The problem is you live with the dollars that come into your pocket, and you learn bad habits living with the dollars in your pocket. So we've now got to adjust back to say, okay, house prices went up too high. People were borrowing way too much to buy homes at an inflated price because interest rates were so low. Well, that's not how it works. That's not the long-term average. So we've got to be a bit better at that. And this opportunity, the optimistic view is this is an opportunity for us all to assess what's valid, what's realistic, what's long-term achievable.
I think with the fixed rates, people, again, this is sort of both sides of it. People going, oh, the worst's yet to come, everyone's on fixed rates, wait till they roll off. But realistically, in the past, that probably hasn't been the case. Everyone's just got smashed at once. At the moment, it's actually drip feeding that pain. So if you know, I got 3 months, 6 months, 9 months, maybe you're lucky you've still got a year or so to go on your fixed rate. We got some time to plan. You've actually got time to work it out instead of next month bang another $100 a week out of your pocket from another hike. You've actually got time. So by having all those fixed rates, it's actually spreading this out over a period of time, which means the economy can actually handle it. And the fixed rates are going to protect us, which, again, some people would like to say, oh, they'll all come off at once, doom and gloom. But it's actually spreading it out. So if you're on a fixed rate and it's going to end, you're probably looking realistically at most people around double, if not more, what their current rate is to what their new rate will be. Start putting some things in place. And maybe okay, well, cash flow is going to tighten up. We'll start using some of that cash flow to build a buffer in or whatever it may be. But it'll actually make it easier, this situation.
I think too, clearly, if we can come back to your, the question Kari asked about how does rising interest rates help stem inflation, we have the media continue to pump up the worst case because that's what people look at. We listen to that. That's what people will read in the papers.
Gets eyeballs.
It makes you look. And clearly the rates are rising and they're rising fairly quickly and there's a need for that. And hopefully that makes people, and again, the media have a role almost in, if people start to get a bit scared, well, whoops, we do. We stop borrowing, we stop buying expensive homes that we can't afford, we stop spending, we try and put a bit away.
It's almost the pendulum goes a little bit too far. Correct. Deliberately.
In every instance that happens. I use the analogy way back when I was teaching and we were trying to introduce Year 12 and Year 11 Phys Ed. And we finally got it approved and they came in with a third year university course, so we had to teach Year 11 kids. Crazy, when you start something that swings way too far, but when it corrects back, it's normal. And I think we probably won't find, again the optimist, we won't find in 2 years' time we're up to 6 or 7% because it will have an impact. It's going to have an impact. It's going to slow things down a bit. And by the middle of next year, there's a bit of optimistic view that doesn't. No, there is some. I've listened to some discussions by people that are not looking at the doom and gloom and trying to sell papers.
I'm rolling my eyes at Peter at this point.
Here we go. We're getting into the pessimistic, optimistic areas.
There's suggestions that this will have an impact relatively quickly on the inflation, and there's a fair chance by the middle of next year, inflation will start to come back. And some are predicting that it could be back under 4. It won't be in the 2 to 3% range. It's going to be back at give or take 4%, not 7.5% where it is now, by the middle of next year, late next year. So, and some of the variables that are causing the inflation are ones that pretty hard to, like the Ukraine-Russia stuff and the price of, oil and gas. That stuff's smashing everyone's cash flow. A lot of the, I think 50% of the increase in inflation has come from two areas: house prices and fuel type. There's 22%, 25% from a couple of variables. Well, if we can get that under control somehow, then it has a very, very quick turnaround, doesn't it?
In some ways, it's better the rates have just gone up relatively quickly because you sort of just get it. You just got to deal with it. They could have drip fed this over 3 years, and it just would have been a slug. And every month it's the same thing. Back to one of your points about the media before. Yesterday the Aussie market's down 1.5%. Call it that.
Actually, what's the date today? Let's say for context.
The 4th.
4th of November, 2022.
I think it was, give or take, it was down that, and it was just everywhere you went, it was bloodbath on bloodbath. Red everywhere.
Went back 3%.
But the market for the Aussie, for the ASX 100, 200 was up circa 10% for the month. So you've gone up 10% in a month, and you hear absolutely nothing about it, and you drop, you give up, a 10% of that 10%, so 1% give or take. You still had pretty good months, but that's not exciting.
That's almost a parallel to property prices too, because property prices, you think about the start of COVID when we weren't quite sure what was going to happen with property markets. For about a month, they started to decline, and then it was, actually everyone's going to get back into the property market, interest rates are low, and we had that sort of false peak of property prices. Now we're hearing in the media this significant drop in property prices. Well, we're kind of just coming back to where we were pre-COVID, and
arguably...
arguably...
Not even back that far, mate. It's nowhere near back that far. We've come off we come off 10 or 15%. No, but
Here we go. Ding, ding, ding.
again, like the amount that it increased over the last 2 and a bit years, and it's come back about a quarter, 10% to a quarter of it maximum. And like yes, it's come back, but it was unrealistically high.
There'll be people that get burnt because they were on the right at the tail end of that too. Like they were one of the last sort of, purchases in that run, and then they're the first ones that when it starts to drop, feel it. But people that purchased 6 months ago are probably still square. And again, it's all about with property. We talk about it a lot. Is if it's in a good location, it's a good long-term spot. Who cares? Like you'll be okay. Depends on where you're at in terms of are you going to live in it, is an investment, etc., etc. There's lots that goes into that decision, but property markets, if you look back, they just go in spurts and then they just be boring for years and years. So we might find, and people have to adjust to this as well, is that you might have paid $750,000 for it now, and in 5 years' time it might be still worth, sub 800, might be worth 760. You probably break even. That's probably more normal than what we've seen. We've just been through an irrational, unprecedented time. So we just have to get used to that. And younger people now are a bit more impatient about seeing results as well. So, a lot of those people, the boomers that bought for 30 grand back in the 80s or whatever, they probably didn't see much growth for a long, long time, and then it just went whooshka. So you just got to stick with it.
You also have to keep in context that we can get so overblown, overreact. You can overreact greatly to the moment. And the moment, if I look at, yesterday and today and tomorrow, oh my God, it could be pretty scary. But if we keep looking in a longer time frame, and cycles go in cycles, but they don't predictably go up for 5 years and down for 5 years. And when the 10-year cycle or the 7-year cycle is not half it up, half it down, there's spurts, there's bursts of up and bursts of down in that. And we have had an unrealistically low interest rate environment for a long time. We've had an unrealistically rapid rise in property prices in the recent times. And the share market has had a pretty positive run. But if we look over 10, 20, 30, 40 years, this is just another example of the rises and falls of interest rates, housing prices, share prices, the works. So if we can get out of the doom and gloom of the moment and start to think a bit longer term and have some planning around battling through these shitty times, because they're going to keep happening. There'll be another Russia-Ukraine crisis in 4 or 5 years' time. Or maybe
something that we don't?
But there'll be something like that. Those things are just... And, if I look at my almost 27 years, there's probably 7 or 8 significant world events. We had the global financial crisis, 7, 8, 9. We've had COVID. We've had Russia-Ukraine. Run them off, the meltdown of the...
there was Greece as well, even that was a mini one too.
And the tech wreck in 99, 2000 or thereabouts, I think back in 94 or 95, there was a fairly significant bond issue which impacted on prices. It's just a repeat of, we get too far ahead of ourselves, things are going too well, and everything pulls back a bit. So
one thing with just a quick one on this point, we talk about rates going up and everyone get, the doom and gloom and negative of it. About the retirees where we've had money parked in cash and in term deposits, and you go, how good's this? It's actually getting something back for us. So again, you have that cash, and we have those provisions for all our clients, whether they're retired or not, to make purchases and take opportunities. But that money hasn't been working very hard for us for.
It's been super hard to find any sort of fixed interest income with some capital stability that is
like a genuine fixed interest. Like you could people would polish it up like it was fixed interest, but it wasn't. But a genuine 3 month, 6 month term deposit, you were getting basically nothing. Where now you're starting to get up in the 2s and 3s even, like it's pretty good. You're starting to see those things. So the retirees should be sort of rubbing their hands together, because their safe money, especially for the retirees, safe money is going to actually start generating something.
As long as they're invested correctly, Ben.
Again, it's all about establishment, process, system around it, is that they didn't chase it. Like I think there's some people out there that got impatient with, and we've had clients, we would have had those conversations over and over again. They go, the term deposit's not getting me anything. Yeah, but it can give you protection, opportunity, and then when you start to come out the other side, it starts to work again. Otherwise, those people now, they've got to pull money out of the market to cover their costs of living at a bad time, instead of having cash available to move into the market. So again, it's all about that establishment and I suppose, our planning piece around it.
Yeah, the process. You talked about it, Peter, that you can get very emotionally attached to decisions, and it's sort of investing 101 to be emotionally detached from it, have a process, and then stick to it, and be consistent whether the market is up, down, interest rates are high or low. If you've got a plan, if you've got a process, and you stick to that, and you've actually got a designated plan, then you're going to come through the other side much stronger than you would otherwise.
And I think that whole philosophy of maybe sitting on the fence a bit, not trying to win Tats Lotto, not trying to time everything. And again, if you're living in the moment, all you're thinking about is, shit, I'm missing an opportunity. Property prices are going up. I've got to buy one. Like, the fear of missing out, that stuff that has been publicised fairly heavily.
Pretty sure we did a podcast on that I haven't released yet.
One day.
But that is almost a natural human emotion. Oops, everything's going great, I better get into it. And again, I quote him many, many times, but one of the wealthiest, smartest investors the world's ever seen is Warren Buffett. He said, I'm buying when everyone's shit frightened and I'm selling when everyone's excited. Like that general philosophy. No, we can't do that because...
Is that verbatim his quote?
Pretty sure that's exactly what he said.
But I think if that fence-sit philosophy that we've tried to build into our business over time is to, let's average into a market. Let's not worry about buying at the bottom and selling at the top all the time. Every now and again you might luck it. You might get a good opportunity and you can do that. But if you just average in, you're buying at a good average price, you're selling at a good average price, you're holding enough defensive stuff so you can get cash if you need it or lump sums if you need it when the growth stuff is actually struggling. So you don't have to sell unless you choose to sell, and you don't have to buy unless you choose to buy. And if we average that, we might not get 20% returns, but we won't get negative 20 either. We're going to get somewhere in the middle. And the same thing at the moment with interest rates and inflation. Well, it's a moment in time. Let's not necessarily go and buy a house right now. Let's not necessarily go and take out a huge extra loan right now. Let's try and work out how
or if you do, make sure that it's done after an assessment of your situation.
Exactly.
I was going to say, if you're in a position and everything aligns that you are ready to do it, then it's a long-term decision anyway. So if everything's there and you're comfortable, you can carry the debt, cash flow's good, there's benefits to it long-term, then you don't have to be afraid of going to buy an investment property or an investment product, whatever it may be. If it all ticks all the boxes, then there's opportunities there. And we've had clients that have still purchased in the last few months, and we've also had clients who have sold to take a profit because where they're at in their journey, it just made sense. Yep. Take it off the table, move away, reposition it somewhere else where it's more liquid or gives it, clear some debt or whatever it may be. It's case by case. So again, in all these things, we probably sound a bit, you don't want to be tarring everyone with the same brush, but it's case by case. For one person,
that's why the analysis is really important. That's why, like you said before, we agree about taking the emotion out of it. If we're dealing with a client situation, we're trying to look at it from a practical perspective, take their personal needs and wants into it to a certain point, but try and override their emotional fears or excitement. So hang on, let's have a look at it practically. Where are we at and what will it look like in a year, 3, 5, 10? And your point again, perfect, Ben. Like if you are living this moment and wanting to do it for the wrong reasons right now, then it could easily go wrong. It mightn't, but it could easily go wrong. But if you say, well, actually, I don't care that I'm paying a fraction more right now because I know I can carry this for 12 or 18 months and I know I'll get a good outcome from another aspect of it, and over the next decade, it's going to make me far better off. Okay, well, we'll run with that. But Delta and I had a catch up with one of our really good real estate contacts, happens to be a client as well, last week, and chatting through the real estate side of things. And it's not that stuff is not selling, it's just that it's not meeting the vendor's expectations at the moment because it's been so quick and prices have been so high. So the discussion was around, well, it's probably back to something normal. It might be 2, 3, 4 months of a place on the market. You might not have 35 people through an open, you might have 5. But places will still sell, and you might say, well, I've got to bring my expectation back by 5 to 10% above what I wanted. Still a damn sight better than it was 2 years ago.
And the demand is down in property, but the supply is also low too. Because people are saying, well, we're not too sure what they're going to do. So the market is sort of just staying really steady because it's a simple supply and demand thing. Is both have fallen instead of this really irrational demand with a okay supply. Now it's just modest on both sides. So you just got to be a bit patient. Like anything, really, don't you?
And property's the perfect example of something that people get super emotional about. And it is also something that requires, I think, if you're going to do a good job of making a decision around either buying or selling a property, that third-party counsel, like having someone that's, you said PB, is emotionally detached. Because as financial advisors, it's kind of the easiest things for us to do. Like we are not emotionally attached to client situation. We can sort of sit with a helicopter view of their cash flow, their interest rate, what the market's doing, and help make those informed decisions.
And
But
be the Jiminy Cricket and challenge what it is they're saying and ask, get them to try and have the client take away the emotional impact and say, well, tell me why is that going to be better for you? Why are you choosing to do that? But it's a difficult one, but I think we have to continue to have the client sitting in front of you and talking about their rationale around it, and then we try and take out of that our view of how it'll work longer term for them.
I was thinking about something you said before, Ben, about people's impatience today, and thinking about why that is, and it probably comes back to this unique period from 2008 to 2022 where interest rates were sort of relatively low. Markets sort of seemed to continue to go up, other than that blip at the beginning of COVID, but it seemed to recover straight away, really quick. And so we almost had this sort of false sense of how things normally are. When we do sort of markets 101, that cycle somewhere between sort of 5 and 7 years, and it was pushed out to like 12, 14 years. So if you think about the person who came out of uni at 20, 21, and for the next 14 years, so they're now 35, and all they've seen is rates being relatively low, property prices continuing to climb, markets being pretty damn good. This is probably their first real taste of, interest rates aren't always low, property prices do fluctuate down, they don't always go up. And like you said, PB, it's a good education. It's a good education for people to realise that there is the yin and the yang. Like, you've got to experience one to appreciate the other, and it's going to be I think the pessimist says that it's going to be a tough lesson for a few, and for those that are well prepared and well planned, you're going to be fine.
Come out okay.
Probably better.
Yeah.
They'll actually will come out better if you've got the right position. And we were talking about before we started, again, that separation between people who are struggling and people who are already pretty comfy. It just sort of continues to widen, unfortunately.
Yeah.
And I'm not sure what changes that back, but we've seen it a lot through COVID, and good luck changing it. Like maybe we'll go to communism for a bit, but
I think that's a different podcast.
Go down that one. But we have seen it widen. I was thinking, I suppose, I'll just scribble down in front of me, like cash flow. I suppose what would be for you both the biggest thing for people at the moment. Everyone sort of, cash flow is where you notice these things. What would be your first thing you would do or recommend people do if they're starting to think, geez, there's not as much there left at the end, or actually there's nothing left at the end of the pay cycle?
Well, I had this conversation with a client only a couple of days ago, and it was around the tightening of cash flow due to interest rates. And I said, well, first of all, what we do is we go back and we have a look at your cost of living, and all of those. And one of the things that we encourage all of our clients to do is have sort of a detailed itemization of their expenses. And what we're looking for is you're looking to identify the things that are levers that you could pull. They're things that you could vary, and most of them are going to be discretionary. And you've then got to make a choice around a trade-off. So if you look at all the things in your expenses and you list, the 5 things that could be altered, they could be changed, and
I could do without that for a little while.
Yeah, I could. Now it might be I'm going to stop contributing to super. It might be I'm going to wind back some of my investments. It might be I've got to make a decision around selling that property. But actually itemizing those and then running through and go, okay, what is the trade-off with each of these? Am I happy to accept that or not? And you might get to the point where you say, listen, I'm not comfortable with altering any of my expenses. Guess what the answer then is? You need more income. So are you prepared to actually go and actually
get a part-time job or something?
Yeah. So, yeah. I mean, the equation around cash flow management and budgeting is a relatively simple one: income and expenses. Am I willing to go and generate more income? Can I generate more income? Am I willing to decrease my expenses? If the answer is no on both fronts, then ultimately the decision will probably be made for you. Like if you get to the point where you cannot afford to fund a property that you've got, then the bank's going to come knocking on your door. So proactive planning, like pulling your expenses up and running through them line item by line item, it's boring. It may be monotonous, but I tell you what, it's a far sight better than having
Have a tap on the shoulder.
We have a lot of your subscription services, whether that's your TV subscriptions or whatever it is. That's been built into us over the last sort of decade, probably mostly in the last 3 or 4 years. So you quickly accumulate all these things without even noticing. And when cash flow is good and interest rates are fine, whatever, another $5 a month, you don't notice it. But it's the sum of parts with all those things. Like you just got to go back through it, and as boring as it is, budget and just looking at what you've got.
YouTube Premium, $15 a month.
Which is, middle of COVID,
Netflix,
you're sitting on the couch, haven't been out for, 6 months, you go, whatever.
Government was paying you to stay home.
Yeah, it was all good. So, as the world's opened up and we've been able to live and do things, then we've added in other expenses on top of that, and then now things are costing a lot more. So, and wage growth has been pretty modest for a lot of people. So, again, it's all those things. Anything else on that, PB?
No, I think that's covered the cash flow, and I think that discretionary and non-discretionary spending, I think that's the key. If you have an awareness of what you don't have to spend money on, and you have an awareness of what your not negotiable cost to live is, well, then it's easy then to make decisions, and that's an analysis you have to do. That the Excel spreadsheet that we provide, just go through that. Which of those expenses don't you have to have? Which ones are not negotiable? And you start. Once you work out that it's going to cost me this much, no matter what, to do the things that I've got no choice about. I need this much per week, per month, per annum. Well, actually, what am I earning? And very often you'll see there's this great big gap between what you're earning and what you're saving, and that's where you do that analysis.
Yeah, and up until now, that gap has in most instances been funded by debt, and now debt's becoming more expensive and it's harder to get. The pressure starts to come. Yeah. And that's why if it's the first time that you've actually looked at your cost of living and your expenses, this period of time is going to be tough. If it's just a revision of work that you've already done previously, which again goes to getting advice early and planning around your cash flow and budget early.
It just becomes a tweaking rather than a massive rebuild.
Yeah, and then you're in a better position, as you said, to benefit or take an opportunity when there's crisis.
Spot on. Just a little aside. I was thinking as we were chatting just before the cash flow stuff. One of the other really good things I think about the fear at the moment about what's going on with interest rates and property is that it does bring us back to that importance of diversification and the fact that too many of us, and we hear the conversation is had all the time, I'm going to buy property because I know I can walk past it and it's going to go up. Property always goes up. Well, this is an awakening too, that it doesn't, it's just another investment. It's just another investment. And that's not to say it's a bad investment, but buying at the wrong time and thinking it's going to go up no matter what is also a bad assessment. And so if you think about having a really broad range of investments across all the markets, not just the share market, not just the property market, not just the bond market, whatever, and you focus on what it might look like over time rather than any moment in time, you probably get a pretty good, okay result.
Just with the property thing, quickly on that, when rates were super low, even for investment, the cash flow of that property it pretty much funded itself too. So you could buy an investment property, borrow 80-90% of it, and it'll just tick over in the corner and no one really cared for it. Now you've got, when the rates start going up, and then you've got the rates are going up, and then the water, and services are starting to go up, and your outgoings are all going up. The rents have gone up a little bit, but not enough to cover that. Now you're finding those people find they can actually tip into that property. So instead of having an investment that looked after itself and just, accumulated wealth for you, you're now finding you've got to actually tip a bit into it. So, yeah, it might be, even if it is going up, but you're actually pouring cash flow into it.
That's right.
To just keep it
capital growth is great, but you can't eat capital growth unless you sell it. You've got to turn it into cash to use it.
In some ways, people, it's almost just, they haven't really thought about it. They've actually tipped a fair bit of their own cash into that property over time. And then when they sell it, they made 40, 50 grand out of it. But they actually put a chunk of cash flow into it over time. If you actually did all the sums on it, sometimes the net result's not as good as what it appears on paper too, which, again, we've talked about that a lot, but it's just another thing that's
just
worse now.
Assessing all the assets that we could possibly invest in, all the assets we could possibly earn income from. All of those things need to be, there needs to be a complement of all of those bits and pieces. And if we focus too much on any one thing, that's a massive risk in itself, because you're reliant on one particular dimension to provide all of the things you want. And that's not good planning. That's not good planning either.
Anything we haven't talked about, Jay?
I think there's a bunch we haven't. I wanted to go deep into a few things. On the inflation front, maybe I'll just get PB's. I'll get PB's optimistic view on this in terms of state governments and federal governments and the level of debt that they carry and the impact that has. For example, Victoria's now has the highest debt burden of, I think, New South Wales, Tassie and Queensland combined. Obviously, it's same with the federal government and the debt that the federal government carries. At what point, and if you look globally as well, how, from an inflation point of view, and how does that ever get resolved? How does that ever get resolved, and does it matter? Because I think that's one of the big concerns for people in terms of the market and where the market, the pessimistic view of where the market's going, is that we're on an unsustainable growth path, and that there'll be a tipping point where the market does have, a significant and catastrophic bear run, which is still coming. So there's a few points to that, PB. Tell me, console me.
Well, I don't think there's any doubt that debt levels are way higher than anyone would like them to be. Governments, individuals, no question. And I think there are some countries in the world that they pretty much manage their economy just with borrowing for some time, and the Yanks are probably a good example of that. Their level of debt in proportion is way higher than ours is. And I think, is it a good thing to say, compared to the rest of the world, our debt per head of population is not that bad compared to some countries? Or is it to say, well, it's still too high? Again, the optimist, pessimist, it's hard to get a balance there. What we have to hope, or what we have to do again, is look at a longer term thing and say, right, why have we got that debt? What is that debt doing for us? And if that debt is creating long-term opportunities, if that debt, for example, is accelerating the rate of renewable energy capabilities so that we can move a little bit more quickly away from fossil fuel and provide, as a country, we need to provide employment opportunities. We need to provide new employment opportunities so that we don't have an issue with having to be reliant on the rest of the world all the time. So if we can create really good long-term employment opportunities, involve new businesses, new industries, if we can provide infrastructure so we can avoid things like the massive flood issues we've got at the moment, be better at managing those sorts of things, that debt will pay for itself over time. And again, the optimist says, well, if it's smart, again, smart debt, dumb debt. If we can get the right debt for the right purposes, I think, unfortunately, a lot of the debt has just been patching up. It's been, filling gaps. It's been Band-Aids. And I guess we've got to rely, to some extent, we've got to push it, because we elect people. If we elect the wrong people and let them run and make bad decisions, that's our own responsibility. So we've got to lean on the politicians. We've got to make sure we keep having a voice and make sure that what they are doing gives us a chance to get through a patch of time where we are at the moment, come out the other side with still the capacity to have a functioning economy and functioning families, and that. And I don't know the answer to that. I don't want to be a politician because it's too damn hard. But I think we as the voters, we as the individuals that put them in power, have got to lean on them. It's a bit like the capacity to make a difference to the environment. Well, each of us has got to take responsibility, and the capacity to help the people who are underprivileged. Each of us has got to take a small responsibility. And that lovely little story about the bloke walking along the beach, seeing the kid throwing rocks into the water, and when he gets to him, he realises they're not rocks, that they're starfish. And the bloke says to the kid, "What are you doing?" He said, "I'm saving the starfish." And the guy says to the little boy, but you can't save. There's thousands of them. How can you save them? And he picks up another one, throws it in and says, no, but I saved that one. And if all of us make an effort to do one small thing, the collective is massive. And I think that's probably what we need to do too from an economy perspective and from managing our government. Lean on them and make a statement about what we expect, and all try as hard as we can to have a small influence, and the collective will be okay. And yeah, we probably are carrying too much debt, but what's too much? And what's it intending to be done with that debt? What will it look like over the next decade with that debt? Let's hope we've got smarter people than you and I and Ben, Jay.
I feel better already, Peter.
Running the economy.
It's like a warm blanket, isn't it?
Yeah.
Well, I don't know. I'm not going to, I promise though, I don't think any one of us is going to do ourselves, our families, our businesses, our own little communities any good by living in a doom and gloom place. We just try and have to be realistic. We have to look forward and we have to lean on people to make good decisions. And what is it that I want the world to look like in 5 and 10 years' time? Well, I can't be disengaged with that either. I've got to be engaged. I've got to actually have an influence some way. And too many people sit in the corner and say, I don't give a damn, I don't give a damn. They can manage it. Well, you take responsibility. We've all got to, whether that be voting for the right person or whether it be making a statement about what we expect. Maybe we can make it work. Let's hope so.
Yeah, personal responsibility. It's a pretty important philosophy, and a lot of people, even the political and economic activists, always get a little bit riled up when you see people gluing themselves to paintings in galleries and think, listen, that's great. You're on the front page of the news, but ultimately, it comes down to individual responsibility. I mean, what are you personally doing day to day to make sure that your little economy, your household, your kids, your business, your community are doing the best that they possibly can do? Because it's overwhelming when you think about the US debt of $30 trillion and how it's going to be resolved, and
insane,
and the impact it has. It's too much. Like we're overloaded with information, and we don't really have the ability, other than, like you said, to have a voice when it comes to your local politics and who you elect. But what you can do is take charge of
personal
your own
choices,
personal circumstances, your own budget, your own investments, the decisions you make. Yep,
all the things. Yeah, giving them an opportunity to make good decisions themselves, and influence the people around you. Have discussions, and don't have a view. Don't have an agenda. Just have a discussion and try and increase awareness constantly with conversations around what can we do to make a difference. How can we make things a little bit better? And if all of us make things a little bit better in our sphere, and that rolls on to the next sphere and the next sphere, and then all the people that we interact with others, the multiplier is massive.
As I say, it's the people around you then
responsible.
that see that, don't they? So if you talk about it in the office and we all start talking about it, and then you go home and you talk about it and it carries out. So just little things.
We can make a difference. We just have to choose to do that. Choices.
Ben, anything else? What else did you have?
I think we covered most of the main items I thought we'd talk through, and we've probably gone down a few rabbit holes, which is always good, but I'm sure we could talk all day if they left us in here and no one came and banged on the door. So I think it was pretty good. They've done a good wrap.
Very good, PB.
Lovely
Thanks for catching up. I know we said we'd need you for 15 minutes. It's now 50 minutes, and Ben, it's good to have you back from your sabbatical.
Good, feeling fresh, ready to go.
All right. Thanks, guys. Bye.
Have a great weekend.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britain FP, or Google Burke Britain Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything.
PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.